Every transaction in accounts has two effects, a debit and a credit. Remember that every transaction has at least one debit, which is abbreviated as DR, and at least one credit, which is abbreviated as CR. A debit simply means left, and a credit simply means right. Let's look at a regular T account. Anything which is entered on the left side of the T account is said to be debited to that account. Anything which is entered on the right side of the T account is said to be credited to that account. Do not assume that debit means decrease or credit means increase. Debit simply means left and credit simply means right. We've seen the expanded accounting equation, assets plus expenses equals liabilities plus incomes. Assets and expenses have a debit balance and liabilities and incomes have a credit balance. Any increase in an asset or an expense has to be debited. Consequently, any decrease must be credited. Any increase in a liability or income must be credited, whereas any decrease must be debited. Let's consider a simple example where we purchase a building from Mr. B for cash. Purchase of a building results in increase in asset and hence we must debit building's account. We have purchased the building for cash, which has resulted in decrease in asset and therefore we must credit cash account. Let's modify the example a little bit. Now we purchase the building from Mr. B not for cash but on credit. When we purchase a building, there is an increase in asset and hence building's account must be debited. On the other hand, we don't pay cash but we now have a liability to Mr. B and hence there's an increase in liability. Therefore, to complete the journal entry, we credit B's account. Stay tuned for more such videos. Visit www.capinnacle.com.